this is the next big move. This is the primary move. This is your most exciting move coming. And it's once you've hit 3 times, you have to wait for that dip to do it. Now, how far does the pullback go? Our worst case scenario would be a revisit to our green line there. It doesn't have to do that, but sometimes it can happen. It's called a return move to the triggering event here. That would bring you right down to the 30s. I don't feel that. This rejection is nothing like the scale of that shooting star rejection. So I think you get a little bit lower. But the next big move is 90. It's going to pause before running 100. And then the next move is 333 for me.
The next phase for silver isn't just another rally. It's the move that defines this entire cycle. After testing resistance near the $50 level, the market's brief pullback is setting the stage for something much larger. Technical structures suggest that this correction is only a pause before silver launches into its next explosive leg higher, first toward $90, then potentially triple digits. Each consolidation has grown shorter and sharper, reflecting the accelerating pace of revaluation across precious metals. The setup is straightforward. Volatility precedes velocity. Those who use this window to accumulate will be positioned ahead of one of the most powerful runs in modern market history. Francishunt, market strategist and founder of the Market Sniper, explains that silver's technical foundation remains intact. The HVF structure signals strength, not exhaustion, and the relationship between gold and silver still favors further outperformance from silver as the gold-silver ratio tightens. The message is simple: the real move hasn't even started yet. Now we present the clips from Francishunt's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
On the silver, we said there's a 45 to 50 range that we think that there's going to be, we go once, twice, 3 times a lady. And many people that draw the classic, what they call the cup and handle, you've had the once of the 1980, you've had the return. We'll go to silver, and I think I'll answer. Let me do that right away because that's your current question. So yes, we foresaw a pullback. We said you're not going to get your face ripping move yet on silver, which tells us that gold, the whole complex, will likely have a rest. And here's the chart for silver. Let me just put it on a quarterly and pull that through. So we said it's quite likely at this range. We put a box on it. We weren't able to give you an exact price point, but we said as you approach 50, quite likely that you're going to receive some form of pullback. And there is a pullback. How on the bigger time frames, it's going to be interesting to see where the month ends. It does point to an inter-rejection. You can see, for example, that was a violent one, a more violent one, and it did lead to further downside. This is actually by log scale, not particularly violent. And we said the pullback will be less and not as deep. And this is the next big move. This is the primary move. This is your most exciting move coming. And it's once you've hit 3 times, you have to wait for that dip to do it. So we did predict that. I mean, we also appeared with Mario, and he was saying, no, I think it just ripped straight from here. And we were saying, no, I think despite it looking super strong right now, that was while this was happening, and you were up at the 54s, we still think you get that rejection. And it came a little later, but there's a little bit of an inflationary tilt to this. This high is tiny bit higher than that one as well. You've got to remember there's a certain time period between each of these and again, the fiat debasement. But so if we do our HVF method draw, which is something that we're unique, we'll recap the silver targets with you. I just have to make one adjustment for this slightly higher high on the second one. It's so close, and we make it just a minor imperfection, 49.81428. That is the high there, and we say leave that one out, and this is what you get. So here's our setup. Now, HVF method is our unique trading methodology, and it got us long this trade well before the cup and handle guys were in here. For them, it was only interesting once we got to the $50 mark, or the $45, $50 mark. For us, you broke over here, and that was still in the 30s. And your stop loss is there, and this has made what we call our first interim target. And typically after running that line, you'll see it there at 40 $40.92. So once you've run 41, you typically get at some point some degree of pullback. Now, how far does the pullback go? Our worst case scenario would be a revisit to our green line there. It doesn't have to do that, but sometimes it can happen. It's called a return move to the triggering event here. That would bring you right down to the 30s. I don't feel that. This rejection is nothing like the scale of that shooting star rejection. So I think you get a little bit lower. The key is the bottom pick you need to do on our leverage trade, because we are turbo stacking ounces. We use HVF method to use judicious tight stops with expansive reward entries to make profits that we then convert into further of these beautiful things, which is a beautiful example, by the way, a little 10-ounce bar there that I'm showing you. I've got a 100-ounce demo here. So we went to the vaults to check everything was still there with our partners. I take one or two samples just for showing on the channel. That is 100 ounces. I'm actually struggling to hold it up. I need to go get back into the gym. But yeah, so it's going to do incredibly well. 100 ounces at about $50, about $5,000 now. That thing is going to go incredibly high up in value. So what happens next is some form of return move. Can't tell you it will go all the way to the green line. I think it's going to be a lot shallower. Sometimes it supports on our first interim target and does a dip there. And sometimes it turns even sooner. So we'll see about that. But the next big move is 90. It's going to pause before running 100. So whatever it does do, let's say it comes a little bit back, that's next key interim level is at 90.9. I need to check, 90.68, around $91. So we're going to pause just shy of 100, or we might just do a technical run of the 100 and get rejected and churn around here for a while. And then the next move is 333 for me. So these open areas between the targets are typically carried with immense, but it's not the same dollar. And there's going to be potentially some degree of crisis that could go along with this. So this is an incredibly positive time. You're still to answer your question, is this a gold top or why is it pulling back? No, because we're at 84 on the gold silver ratio. So, we haven't even gone through 75, 72, which is a key level for us. I think people should be now prioritizing silver a little bit more. But remember, gold runs first and hardest. And when we talk about the gold-silver ratio, let's bring it up again. We were the one people that said, if you were to get, and we've spoken about this Cayman Islands Ponzi scheme, how there's these proxies that are always ensuring strong demand for, dollar-denominated debt that's hopelessly over-leveraged and are being lent money by primary dealers in the debt markets that are certainly part and parcel of this cartel. You've been stuck in the gold-silver ratio for quite some time in this range, around about the 75 to 95 range. And if we were to have a major crisis, actually the central banks will be the biggest drivers and they'll buy gold. You could still, and we hang on to that, you've had a little bit of a hammer there, you could still get a pop out the top. We have suggested it before. We're not saying it's our base case, our priority case, but you can still, if we get a crisis, you'll have a reduced industrial demand, business will stop, and you'll have central bankers reallocating more aggressively to gold in lieu of preservation. So we could still pop out again. We know the real silver bull trade is when we leave this box and we run that low, which is in and around the 72. You might support again at the 60s and have a bounce. Then, we go lower, lower, lower. That's going to be very exciting times for the silver guys. And that's where I see those bigger numbers coming. How long it will take in between for that, it depends. If we are to get a financial crisis in between, as I say, silver will be held back for a while. That is why I say it's a gold trade first and foremost, because the biggest buyers are the central banks and the institutions. If you haven't got gold, you should have it, and it will run first. It's the king of the anti-fiat market.
Gold's recent movement has followed a textbook technical rhythm, a clean double top, a sharp correction, and now early signs of stabilization. Momentum on the downside is beginning to fade, and volatility is calming after weeks of aggressive selling. This pattern suggests exhaustion among sellers rather than renewed weakness. As price structures start to form potential reversal setups, the likelihood of a bottom forming increases with each passing session. Silver is mirroring this behavior, having completed multiple downside targets and now hovering near key structural support levels. While it's still early to declare a confirmed low, both metals are showing signs of firming beneath the surface. The worst of the sell-off has passed, and the markets may be preparing for a slow reversal phase before the next advance begins. Technical evidence points not to collapse, but to consolidation, a market quietly rebuilding its strength. Let's get back to the interview.
Gold. Let's go to the lower time frames now and just show you. We had a little bit of a double top that broke down. I'll show you that. So technically, everything it's done has made sense. Let's just get that pulled through. So you had a double top there. So that's this part of it. And big slap in the face here. And then you rebounded. That was the dip buyers coming in late. And then you get the bigger dip. That's your neckline target made on that wick. And then we had an inverted HVF like that, which is this. That also made its target. I'll draw it for you. And we've had all the downside targets made. And what I like about this a little bit is there was a possible risk of a larger head and shoulders, where this is the giant head, and you would have needed a shoulder rally, but you ideally needed the gold to support on the neckline, that blue line that I've drawn there. So this is what I was drawing. I was highlighting the double top. So let's do it again. I've done it in pink. That's just overdraw. So there it is in blue. That was the W top. It's kind of like an M. That was the blue neckline at 4,200. And that target got generated and ran the wick there perfectly. And I was just describing how you had an inverted HVF in here that generated a downside target, and that was made as well. And the one thing I was highlighting, and let's just remove all of that now, is there could have been a latent danger if we had supported here at the 3,950 and done a rally from here. You could have had maybe a really big head and shoulder with a further move to the downside. But in actual fact, by running lower, it spoils that. We only see horizontal necklines with key levels. So by spilling through that, it's lost the likelihood that it reduces. I won't say entirely, it reduces the likelihood that we're in a bigger head and shoulder downside move. So I would say you could start looking, you might get another revisit, but when we get a double bottom here and a bounce, you'll end up with the equivalent reversal here. Or you could have even better and quicker, you could have a little on a lower time frame, a little reversal like that, for example, and you could start moving your way back. I think I don't have a strong bias here. I'm not leveraged yet. We look for a little bit more before we call bottoms, dangerous activity. But I think there's a reasonable chance that you might have made your final low already. That doesn't mean you can't come back and retest it, but you could start setting up reversal structure. And some of the speed in the sell-off, this was violent. You can see it particularly violent there. This was more moderated as well. So you tend to see the momentum going out of the down legs as well. And now you've had a rally and a tiny correction. It's calming down. It's going lower vol. There is that possibility, as I was saying here, just to have, we could be making a right shoulder here for a small reversal pattern. Now that would generate an upside target. It would be the first in a while. That could bring you up here. Then you could be in another, you go back to nestled head and shoulder. You could be in another left. You could be in another head if you made it there. Then you sell off a bit, create a right, and then you're in a bigger reversal pattern. So, there's quite a bit of assumption. I'm getting ahead of myself there, but it looks like it's slowing down on its momentum to the downside and dissipating. And silver, to be fair, the same. I actually did a very small, it's a bit early to be, but I put a tiny silver trade on just for the fun of it because it started to look like it had also very much done. You see it had a head and shoulder silver, slightly different structure, not the double top, sold off really brutally here. This was also a warning. We pointed out this in our community. You've got a broadening structure there. That's called a megaphone, and it's an ascending megaphone on a bull pole. That is typical. You make marginally higher highs. That's the beginning of exhaustion. You had this flag structure here. Once you came down really hard, you bounced on a logical number, 50.65. That was a head and shoulder, so we drew it. It was quite clear that it was tapping out on strength. That had done a bit much. There you go, reversal structure. You could have shorted early on the flag. We will never short because we're just too bullish, even on short time frames. So we just stand out. You get out of your longs. That flag was made, that target, that's a flag target like that. That was made there. And then you got a little inverted here like that. And that target's been made as well. So you've just made a bunch of targets and now you're bouncing and you're rallying. Still early doors to say 100% this is done to the downside, but it's come all the way back to this inverted structures funnel level and is resting in there. So there is signs of a little bit of firming up on the silver market. So I think people that are calling for really low numbers are wrong on this. I think you could be not very far from basing. I have a bull bias on the macro, so you have to bear that in mind. But the technical patterns have been made. The only way, how do we be wrong? I always ask the question, how do we be wrong on this? If you're not prepared to ask that question, you'll be caught out. And the best scenario I can draw that could see us be wrong and it goes lower, let me just tidy up now, would be something like this on silver. And it's similar to the gold. It would need to happen on gold as well. I say that's a very small shoulder for the proportion of this head. And you'd need that to sell off hard back down to here. If we sold off hard and strong back down, this is a 46 mark, that could be something. But again, it's not proportional. The shoulder's really small compared to the head move. It's a bit of a sketchy head and shoulder, and you would need this to show real downside momentum hard here. So if you came down hard back down to 46, you'd have to consider the possibility, and that target is 37 for that head and shoulder to have a sell-off. But I look at that and I say, how likely this was a better example of a proportional head and shoulder, the monarch, as we call it. It's the king right in the middle. It's the first one. You do sometimes get what we call nestled head and shoulders, but these are disproportionate. These are really small shoulders. So I don't think this is not my base priority case. But if we sold violently down and there was real introduction of momentum like here, you can see the momentum in there, then you'd have to say, okay, if we did that, we got to watch it. That could go for a bigger break to the downside. I'm more prone to thinking that you could even be seeing some form of basing.
The pressure building beneath gold and silver isn't weakness. It's the quiet phase before acceleration. Every correction, every bout of fear in the market has served the same purpose, to transfer ownership from weak hands to strong ones. What appears to be exhaustion on the charts is often the final shakeout before a major trend resumes. The structural patterns now forming suggest that both metals are aligning for a renewed move higher, one that could catch even seasoned traders off guard. As global liquidity tightens and financial confidence erodes, the foundations of sound money grow stronger. The real opportunity lies not in achieving perfect timing, but in understanding the trajectory, from correction to continuation, from fear to realization. When the next breakout comes, it won't wait for confirmation, it will simply run. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.